All right, for those still trickling in here, we'll kind of start the slow part of the presentation. But first and foremost, I want to thank all of you for joining us today on a pretty timely topic of stable value versus money market funds in today's interest rate environment. Just a couple of quick housekeeping items. All of your lines will be muted. We are recording this. The chat functionality is enabled, so feel free to shoot us some questions via the chat. The chat is private, so Sean and myself and a couple of team members will be monitoring the chat box, and we'll try to get to as many of your questions as we can today. We'll try to answer a couple along the way. Anything that we don't get to, we will be following back up, so your consultant will be reaching out, or if you don't have a dedicated consultant yet, a member of the team will be reaching out to you as well. Before we get too far into the presentation today, just a quick word from compliance. As Sean and I present the materials today, we will be talking specifically about generalities when it comes to these types of investment options. Just know that there's a lot more nuance as you get down to individual strategies, but trying to make the conversation as appealing to the widest demographic, we'll be using a lot of generalities in talking about these capital preservation vehicles. For those of you that don't know me, my name is Brian White. I'm a principal and senior consultant at the firm. I've been with the firm for 16 years and primarily focus on defined contribution plans, servicing defined contribution clients of all sizes. I'm joined today with a colleague, Sean McCaffery, who's a senior defined contribution research specialist. So within the research group, Sean really oversees a lot of the direct oversight of those more defined contribution specific type products like cash preservation vehicles, target date funds, managed accounts, and the like. So we're happy to have Sean kind of joining us on today's call to give some insights on what's going on in the marketplace. So why are we actually meeting today? Well, with the Federal Reserve laser focused on combating inflation, one of the things that they've been doing is raising interest rates at a pretty aggressive clip. And what that's led to is that, at least in the short term, money market funds have started to outperform some of your other traditional capital preservation funds like stable value or general ledger accounts. As we look at this chart, this is, once again, from a 30,000 foot view. It's not trying to promote any one product or strategy over another, but it gives you a look of how interest rates impact these types of products. And so the greenish line that floats around the bottom of the chart there is the FTSE T-bill. This is an index that we typically use to benchmark money market funds with. This particular index is very sensitive to the Federal Reserve's interest rate movements, whether going up or down, and moves in line with what the Federal Reserve is doing on that front. The purplish line is a sample stable value fund, and we're going to talk about a couple of different types of stable value funds. Generally speaking, directionally, this kind of represents a typical stable value fund. And what you'll see is that as interest rates go up and down within the money market, there is a little bit of a lag in the sensitivity of these returns, but also a much more smooth ride for the participant that's in these particular products. So you don't see as quick of highs or as sharp of lows in some of these more traditional stable value products. But the reason we're having this call today, if you look on the far right-hand side, is that we're in an environment now where the Federal Reserve has been raising interest rates extremely aggressively. And we find ourselves in a point in time where interest rates on the money market funds and the yields on money market funds are much higher than what we're seeing currently within stable value. Even though stable value has also been increasing off some of their lows from last year, it hasn't really kept pace in the short term. And that's really led a number of participants and plan sponsors to reach out and say, hey, we only offer a stable value fund now. Can we add a money market fund, or what's the benefit of doing something like that? So as we set the stage for today's discussion, a couple of the items we really want to discuss are, one, what are the types of capital preservation funds available to plan sponsors to offer within your core investment menu? How do they typically behave underneath normal circumstances? What's going on now that makes this a little bit unique? And then what options do plan sponsors have going forward as far as revamping their core menu or just understanding the space better to stay the course? So without further ado, let's jump into this. Sean, maybe the first question I have for you is, as we talk about capital preservation funds, can you kind of give us an overview of the different types of funds specific to their uniqueness within the defined contribution world?
Yeah, certainly, Brian. On the page here, I would say we have the table of the predominantly used capital preservation structures. I would note the footnote at the bottom referencing that this is for illustrative purposes only, and it's certainly not an exhaustive list. So I'll reference that money market, synthetic CIT stable value, general ledger stable value are the most predominant. Plan sponsors certainly could select from short duration, ultra short duration, other fixed income mandates, or even other stable value structures. To put some numbers behind that statement, though, we see, generally speaking, plan sponsors about 70% of the time offering a stable value to their participants, and roughly 35 to 40% of the time offering a money market. Now, at the most basic level, all three of these are fixed income portfolios. Their primary objective is capital preservation, to your point, Brian, with maybe a secondary objective of a suitable return. We walk through the three of these. We reference money markets. These are going to be shorter term securities backed by the US government and typically offered by money managers. Middle column is going to be synthetic CIT stable value, CIT referring to commingled investment trusts. And these are going to be fixed income portfolios wrapped by insurance providers, typically multiple, and this is offered by money managers as well. And last, we have general ledger, also known as general account, fixed account, or GICs, which is guaranteed investment contracts. All of those naming conventions, really for purposes of today's discussion, are pretty synonymous with each other. These are going to be offered by insurers and typically are backed by a single insurance company. So the two on the right are stable value offerings. Far left column is money market. Stable value, I'd be remiss if I didn't say some of the unique qualities of that is it is backed by insurance, whether by multiple wrap providers or a single insurer. Certainly unique in that it's protecting participants from downside market drawdowns, right? So these are underlying fixed income portfolios, can experience market drawdowns, but at least from the participant standpoint, they're not going to see that, right? They're going to have capital preservation because an insurer or insurers would step in and kind of cover those losses. And that's what's known as always transacting at book value for participants. As I mentioned, these are all fixed income portfolios. Some of the areas we focus on for fixed income would include duration in the investment universe, right? What we're actually investing in. So why don't we talk through some of those? First row would be duration, or simply the sensitivity of these portfolios to changes in interest rates. If we were to think directionally speaking, those portfolios investing in longer maturing securities, typically going to have a longer duration profile. Brian, as you mentioned, money market is going to be the shortest term government-backed securities. We have on the page here 6 months or less. I would say in practice today, we probably see most around or even less than a month. Moving a little further out the yield curve, we have synthetic CIT stable value, typically targeting around 3 years, but I would say that can certainly differ depending on provider, but also market environment. And again, moving further out the spectrum, we have the general ledger stable value, probably the widest variation of duration, but typically see it within that 4 to 8 year timeframe. What are these investments actually investing in? Among the three, I would say money market is probably the most plain vanilla in terms of what they invest in. All of the securities are going to be short-term in nature and backed by the US government in one way or another, whether it be US Treasury bills, US obligation bonds, or repo bonds that are backed by the US government. Building on that investment universe a little bit, we have CIT stable value that will invest in all the aforementioned US government securities, but in addition to that, we'll do corporate bonds, whether investment grade or non-investment grade, as well as securitized assets. Think money-backed, mortgage-backed securities, asset-backed securities, commercial mortgage-backed securities. Expanding on that universe a little bit more, we have general ledger. These portfolios are typically going to be fixed income in nature, but definitely will have some extended asset class exposure. When we think of some of those asset classes, it might be public equities, private equities, REITs, private or direct real estate, collateralized loan obligations, and other. But again, will be predominantly fixed income. So we've talked about some of the investments under the hood, maybe pivoting to the operation side of it. When we're discussing capital preservation vehicles, we typically get questions from HR benefits folks on what is the participant liquidity? Simply stated, for all three of these, they are all daily liquid, or what's known as benefit responsive. So participants can pull money out of any of these three structures at any time. Where it differs among these solutions is at the plan level. You see that in the following row, we have plan level discontinuance. This would be if a plan sponsor wants to move to another money market or stable value, or simply do another asset class altogether. For money market, they behave much like it would another fund in the core menu, certainly interaction with the record keeper, certainly communications and notice to the participants, but otherwise fairly straightforward. Where it becomes a little bit more of a challenge is within synthetic CIT stable value and general ledger. So starting first with CIT stable value, they are able to enforce what's known as a put. Typically, this is 12 months in duration. And what this means is that plan sponsors looking to move money from the stable value would need to wait a period of 12 months, typically, for those monies to move from the synthetic CIT stable value to wherever they're moving it to. Now, during that time, during that 12-month time frame, these solutions are still benefit responsive to participants, and participants are still earning a crediting rate on that investment. Moving over to general ledger, again, there's another provision in place, but typically it's a little bit longer. I would say we see 3 and 5 years being most typical, but can certainly range from 1 to even 10 years. Unlike the put process where all the money moves at the end, this is typically done over installment periods. So if we were to take a 5-year, for example, you would see 20% move over at the end of year 1, another 20% at the end of year 2, so on and so forth over the course of 5 years. Now, if we were to think of what plans are actually able to invest in these, maybe starting on the bookends, we have money market, you see available to all, general ledger, stable value available to all as well. So across all defined contribution plan types, whether it's 401k, 403b, 401a, 457, all of those can invest in both of these structures. The nuance here would be with CIT stable value. As mentioned before, CIT is commingled investment trusts, and to date, 403b plans are unable to invest in this type of vehicle. Now, there was some thought that there could be some color around this with Secure Act 2.0, came out last year. Unfortunately, for those that were hoping for this, it was not actually clear if CITs were going to be made available to 403b. Largely not available for 403b plans.
Thanks, Sean. As I'm going through the questions, there's a couple of common ones that popped up, specifically as it relates to money market funds and the looming debt ceiling. What kind of impact would the U.S. defaulting or the looming debt ceiling have on a money market fund or these other two vehicles?
Yeah, certainly a timely question. One candidate we could probably spend a lot more time on. I would say of the 3 investments, right, all invest in U.S. Treasuries to some degree. So there could be an impact depending on how long this would persist and magnitude. I would say money market is probably the most likely to be impacted. We've had conversations with a number of the largest money managers for money market funds. Most seem confident that the government will come to a resolution on this topic, though what seems like it'll be kind of last minute, or we'll maybe have a short-term fix and kind of punt the issue till later in the year. In terms of how they're investing right now as such, it seems like there is a maturity window, maybe between July and September, that'd be most susceptible to kind of adverse impacts from this. As such, it seems like most managers are trying to avoid this period. They're taking a bit of a barbell approach in terms of investing. So investing in securities right before that window and right after that window, but largely achieving the same kind of weighted average maturity that they want to achieve.
Great, thanks. And so as you've kind of given us the backdrop on these different types of vehicles and their structures, as a plan sponsor thinks about the core investment menu and how they should best plug a vehicle into these different asset classes for their participants to choose from, how would you look at these as far as kind of a risk return potential from underneath normal circumstances?
Sure. And I think certainly the normal circumstances is definitely a key point here. This would be over a long term, right, or a full market cycle in terms of expectations. And again, I would point viewers to the statement at the bottom, right? This is for illustrative purposes only. We have a bit of a linear chart here, but in actuality, the markets are rarely linear. So we have on the y-axis here, expected return potential, pretty straightforward. X-axis, we have typical duration, but really could include investment universe or even credit risk on this axis as well. We start with money markets, so that's going to be the bottom left-hand side, the green circle. Certainly shortest term in terms of duration and maturity, and expected return is probably the lowest. Moving out to synthetic CIT, again, we're going a little further out in the yield curve, a little bit wider universe, a little more credit exposure. As such, we would anticipate as investors to be compensated for that, and thereby would expect a higher return than money market over the long term. Lastly, going one further out, general ledger, again, further out on the investment spectrum on the yield curve. There's also considerations from the discontinuance provisions with plan sponsors. As such, investors, participants, plan sponsors would expect to be compensated for this. And that would be the largest return expectation over a full market cycle.
That's helpful. And especially with today's environment with the inverted yield curve, obviously that money market is much higher on the left-hand vertical axis than the other two. And so it's causing these short-term questions from participants and plan sponsors. You mentioned a couple of times about whether it's synthetic stable values or the general ledger, these wrap providers or wrap insurance that's providing the stability of participants having that benefit responsive benefit. So how do they go about protecting themselves in periods of stress that we're seeing now where their market value may be below their book value?
Yeah, great question. I mean, we certainly discussed from a plan level some of those discontinuance provisions, right? Those are to protect the remaining participants in these portfolios, but also the insurers, right, that are willing to wrap this. They don't want to have kind of a run on the bank. Now, there's also some provisions in place at the participant level, as you have on the slide here, known as equity wash provision. I have the definition at the top, but simply what this is are provisions that stable value mandates implement for participant level or participant directed transactions. So participants cannot go directly into what's deemed a competing fund until they've waited a period of time, typically 90 days, and we typically refer to this as a 90-day equity wash provision. So in terms of why, as we mentioned with the plan level, right, this is to protect remaining participants as well as the insurers, right? In terms of backing this, trying to protect from any downside, there needs to be some provisions in place that, for lack of a better term, prevent a run on the bank or run on these strategies. Now, what are the actual impacts? Well, certainly from a participant standpoint, you might need to wait a period of time before you're able to go to something such as a money market. Defined as competing funds has become a more narrow framework. I would say a handful of years ago was anything with maybe a duration south of 3 or 4 years, maybe included self-directed brokerage, maybe included balanced funds. Today, we see it typically as fixed income portfolios with durations of 2 to 3 years or less, generally not self-directed brokerage or balanced funds. But again, this is going to differ by money manager. In terms of considerations for the plan sponsor, right? Certainly want to be aware of what these nuances are. Certainly going to have participant questions come up if both stable value and money market are available to participants. But I'd say in terms of making plan menu design changes, right? There's a period of time typically needed in order to potentially add a new fund. We think of maybe 75 days on average. But then for participants, maybe even take advantage of a higher yielding security, there might be a period of time on top of that. We think of typically 90 days. As such, we might be looking at maybe 6 to 7 months before a participant could actually take advantage of a new offering within their plan menu. Certainly not trying to make a market call, but it's safe to say that the market 7 months from now might not look like it does today.
No, that's helpful. And as I think about this, from what the question is that we get from plan sponsors recently is we only have a stable value or we only have a general ledger account. Can we add a money market fund to give participants an option, right? And I think the simple answer to that in most cases is yes, you can do that, with the caveat that depending on your individual product, there will be some sort of equity wash provision in place. And so one of the questions that's popped up here a couple of times in the chat is, can you give us an example of how this would impact a direct participant if they can move from a stable value fund to a money market fund? So as Sean kind of mentioned, assuming that the money market was in place in conjunction with your stable value product, regardless of general ledger or collective investment trust, a participant could not take $1,000 and move it directly from the stable value into that money market fund. Instead, what they would have to do is move that to a non-competing fund. And if I use a more extreme example, that $1,000 may have to go to an S&P 500 index fund for 90 days first. And while, yes, it's a new investment option that could potentially make money over that time, or it could potentially lose money. But at the end of the day, that's going to be a much more volatile experience than for that participant that's in the cash preservation fund for the first reason, which is not to lose money. And so you can offer this. As an organization, we have clients that only offer money markets as their capital preservation fund. We have clients that only offer a stable value or general ledger account. And we have clients that offer both with this equity wash provision in place. At the periods of times and stress, we should never be making reactionary decisions. And I encourage you to work with your consultant to determine the best path forward for you and your organization about which method of cash preservation vehicle makes the most sense for your organization. The last question here is, let's see here. No, we just answered that one, so we're good to go there. As part of our annual fiduciary governance calendar, on a quarterly basis, we meet with our clients to talk about different topics outside of just investment performance. We're finishing up our fee focus this round of quarterly meetings, but as we meet to finish up the June 30th meetings at the end of Q2, one of the topics that we'll talk about is your stable value and or general ledger account, and do a full deep dive review to make sure we understand what their underlying investments are, what the crediting rate currently is, what the market to book ratio is, and how healthy that portfolio is, and any kind of restrictions associated with that. The last question I think I saw here is that, can we just remove the stable value option and add a money market fund? To answer that, once again, yes, you can do that. However, there is that 12-month put or that extra liquidation period in a general ledger account that you would have to notify the record keeper that you're doing this and the investment manager, and you would have to hold that fund for a period of time before we could actually make that change. So there are certainly things that we can do in this scenario. But once again, understanding, hopefully at the beginning of this conversation, what these different investment structures are set to do, what their goals and objectives are, how they can offer higher yield and underneath more normal circumstances, and why they can be a little bit more restrictive to just kind of cut bait and run when their strategy isn't necessarily in favor. The last thing I'll leave you with all today is that we continue to put a lot of thought capital and research on our website. So if you can attend our fiducient.com and click on the Insights tab, there's a number of webinars, recordings. We try our best to push out relevant information to you regarding your plan, but we also don't want to inundate your inbox either. I know there's a couple other questions we didn't quite get to today, but I think I'd rather give you back some time for the rest of the afternoon. We want to thank you for your continued support in the firm. Anyone that has questions outstanding, we will forward those to your consultant, and they'll be reaching out in the next couple of days to get those answered. In the meantime, thank you, Sean, for participating, and thank you all for attending, and have a great day.